Okay, thanks for staying with us. Time now for business, for which we're joined by Will Edwards. Hi, Will.
Hi, Georgia.
Okay, so we're starting off here in France, and the government's getting ready to give its plan on how best to give the economy a kickstart.
That's right. Now, on Monday, we heard from Louis Gallois, the former head of EADS and France's state railway system. And, he was telling France how they should get their competitiveness back, get their mojo back, as it were. His headline suggestion was to cut 30 billion euros in social charges that are paid by both employers and employees. But will the government listen? That's the question. There have already been reports that they're going to ignore some of those suggestions. And in fact, instead of this plan to cut social charges, they're going to put in place tax credits for businesses. And these will be linked to the proportion of employees that a company has in France, i.e. if they have more people working for them in France than overseas, they'll get more of this tax credit, and that'll encourage them to keep workers in France rather than exporting jobs.
And what and how any of this is going to be paid for?
Well, that's probably going to come down to sales tax. We're going to, like I say, be hearing about this in the next few hours. But sales tax is likely to be increased up to 20%. But that is a rather politically sensitive item for François Hollande, who campaigned against Nicolas Sarkozy by saying that he wasn't going to raise VAT. Essential items, therefore, such as food, electricity, they're going to see their tax drop from 5.5% to 5%, maybe to slightly mollify some of François Hollande's supporters.
Okay, so we'll be hearing more about the government's plans a little later on. But in the meantime, many businesses have welcomed the suggestions put forward in the Gallois report.
500 million cartons of milk and juice roll off the production lines at this company every year. Despite an annual turnover of €303 million, staying competitive is a big concern. The company has been losing market share to German competitors. Its CEO has welcomed Louis Gallois' proposals.
The report recommends removing the family allowances levy, which for a worker that earns €1,700 a month amounts to €91, so that makes our companies more competitive.
Along with many employers, reducing the cost of labour is something he's wanted for some time.
A carton which comes from our factory costs around €1. About 20% of that is labour cost. So a reduction of 10% saves us 2 cents on each unit. That allows us to regain our competitiveness and to win back the business we've lost in France to competition from abroad.
He also intends to take advantage of proposed measures to boost innovation. The company already allocates 3% of its turnover to product development, and the CEO wants to increase that. But the workers here are worried. If employers' levies are reduced, they're afraid that'll translate into an increase in other taxes.
We never get a fiscal gift just like that. The reductions are good, but behind that we must see how that will affect us. A hike in VAT and social charges.
Both companies and workers are now waiting to see which measures the government will choose to implement.
I think it's about time to have a look at the markets.
Yeah, well, things are just opening up in Europe, of course. Let's take a look at how things are going. Early days yet. But so far, most of the markets there are in the green, and the Madrid IBEX completely flat. Marks & Spencer's is one stock that will not perhaps be seeing such a good day in London. Their profits are down 10% in the first half. Their sales have risen, but costs have risen more quickly. Let's take a look at how things are going in Asia. As you can see, things closing largely down there, except for the Kospi in South Korea. Light trading sessions at the moment ahead of the US elections in particular.
Okay, changing gears, excuse the pun. We're going to be having a look at the car industry, where sales of luxury automobiles seem to be going from strength to strength.
Yeah, unlike mass market cars. Now, we've heard a lot about Peugeot, Renault, Opel, the GM arm, European arm of GM. They're not doing very well at the moment, mass market cars, but premium cars doing a lot better. BMW has their profits out this morning, and they are the latest to add to this trend. Their net profit was up 16% in the third quarter to €1.3 billion, and it's mainly down to sales in China, in fact, where sales were up a massive 30%. In Europe, not quite so good, but sales were still up 2.6%. But actually, even in its native Germany, BMW actually saw sales fall slightly, so it's really China pushing this growth.
But not such good news for Nissan, though.
No, well, their latest quarterly profit was up slightly, but they have slashed their profit forecast for the year by 20%. They give three reasons for this: a strong yen, weak demand in Europe, of course, as we've been just talking about, and, of course, those disputed islands between China and Japan. They have caused, a few weeks ago now, Japanese car dealers were being attacked by angry protesters in China because of those disputes over the islands, which have called Senkaku in Japanese and Diaoyu in Chinese.
Okay, now all eyes are on the US today, of all days, because of the election. And of course, New York, a lot of people in New York are still suffering from the after effects of Hurricane Sandy, but that doesn't seem to be the only one of residents' problems.
And no, of course, they've got a lot of issues with getting basic supplies, and it's being reported now that people are overcharging for basic goods. That's according to New York's Attorney General, who said he's received hundreds of complaints of people profiteering on basic services and goods, things like generators, food and water, even hotel rooms for people who've been put out of their own houses. And there's actually a New York state law which says that in times of abnormal disruption to markets, people should not be able to charge excessive prices. Now, of course, it's rather difficult to judge due to supply and demand if a price is just raised above the usual because there's more demand for it, or whether it's excessive and it's profiteering. But there is now going to be an investigation into that.
Okay, now Spain is one of the countries that's been worst hit by the Eurozone crisis. But the government is placing its bet on a new project that could help bring back jobs. It's a gambling development that's been dubbed Eurovegas. But not everyone's convinced. France 24's Sarah Morris has this report from Madrid.
Roulette tables, palm trees, a strip of luxury thematic hotels, the mythical Las Vegas could soon have a European copy in Madrid. Land on the outskirts of the Spanish capital is earmarked for the future Eurovegas. 18,000 slot machines, 3 golf courses and 36,000 hotel rooms.
In the first phase, we're expecting 60 to 70,000 jobs to be created. On top of that, we're expecting business tourism to be generated, really top-end tourism. We're talking about a series of 5-star hotels with 70-meter suites.
Skeptics say the complex isn't the solution for a country in recession. Building won't start in this area until December 2013. But unemployed workers here are already preparing their CVs.
It's our big hope. My girlfriend and I have already looked into where we can apply.
We'll probably have to work like slaves for a pittance of a salary, but that's how it is now. Anything resembling a job, and you leap at it.
Spain shouldn't get into the gambling business, say opponents of Eurovegas. They say Madrid shouldn't use this land for another big building project which might not be profitable.
This project will worsen the crisis even further. It will turn southern Europe into a place where people come to spend money on gaming and vice. The money will leave the same way it came from. It won't be reinvested in the local economy.
Eurovegas is still not signed and sealed. The company Las Vegas Sands is still negotiating tax and legal terms with the government. Madrid hopes it can soon make the deal a symbol of returning investment to Spain.
Now, finally, Italian police have made a rather grand asset seizure in a crackdown on tax evasion.
Yeah, now often tax evasion asset seizures include things like cars and works of art, but this one included a whole castle, in fact, which you can see there, a 15th century chateau near Vicenza in Italy. This is linked to the sale of Valentino, the fashion brand, in 2007. Italian investigators, prosecutors are saying that 13 members of the Marzotto family failed to pay up to 65 million euros in tax. Now, these items have been, including the chateau, have been taken preventatively because it's not yet been proven, but nevertheless, at the moment, Italian investigators have a nice place for the weekend.
Brilliant. Well, thanks very much. Will Edwards there with our business roundup. Well, that's it from us here in the newsroom for now, but stay with us. Short break and more coming up.